anglais, s'il vous plaît.
So each team has 20 minutes to present its case to the judges. I will hold up a sign for the last 10, 5, and 2 minutes, as well as for the last 30 seconds of the presentation. During the last 10 seconds, I will indicate with my finger the number of seconds remaining. If you have not finished your presentation after 20 minutes, you will be stopped in order to proceed with the Q&A period. A Q&A period of a maximum of 5 minutes is allocated to the jury at the end of the presentation. Please know that at any time you cannot say or refer the name or the location of your university.
Three, two, one. Happy New Year! As you know, it's January 5th, 2013, and you've just finished making your New Year's resolutions. Now, many New Year's resolutions have to do with reducing things. Maybe your golf score, maybe your waistline, or maybe your income taxes payable. Good morning. Myself, Thea, David, and Megan are here today to help you, Monsieur Fontenelle, achieve that resolution of reducing your income taxes payable. We're going to discuss today the disposition of your preferred share in your sister's company, Gestion Mélanie Incorporée. We're going to talk about the potential acquisition of the Eurolife franchise. And in discussing that, we're also going to discuss a restructuring of your company, your management company, Gestion Fontenelle Incorporée. And finally, there are a number of personal and family tax issues that you come to us with.
Now to begin, we're going to talk about the dispositions of your shares in Gestion Mélanie Inc. Now, a while ago, you invested $500 into your sister's company in return for preferred redeemable shares. Now, at this point, your sister no longer needs this investment, and you no longer want to have involvement with this company. So we've come up with two different alternatives that will allow you to no longer have your shareholder status in this company. The first alternative is for you to redeem your shares in the company and have Gestion Mélanie pay you for these shares. Or you could sell your preferred shares to your sister in return for her paying you directly for these shares. Now, if you were to redeem your preferred shares, the company will be paying you out of the company funds. And since you originally paid $500 for these shares, your paid up capital is going to be $500. And the amount of money you will be receiving from the company is $10,000 because this is what was stated in the original contract when you purchase these preferred shares. Now, because of this, your redeemed dividend will be $9,500, and you will have no capital gains due to the formula that we calculated for you. Now, this dividend will be grossed up according to the rates, and then you will receive a dividend tax credit on the gross up when you file your tax return. Now, if you were to sell your shares instead, you would receive the money directly from your sister, so she would need to have the money to buy you out of her company. And again, your proceeds of disposition would be $10,000, and you subtract your accumulated or adjusted cost base, which was $500, the money you put into the company, and that would give you your capital gain, which is $9,500, and half of this amount will be taxable. So their taxable capital gain will be $4,750, and this is the amount you'll be taxed on. Now, if your company is a qualified small business corporation, you may have an option to not pay the taxes on this. Now, a qualified small business corporation is a company that employs over 90% of its assets in Canada, 90% of its assets and active business income carried on 50% or more in Canada at the time of sale. Now, if this occurs, Gestion Mélanie would qualify as a small business corporation, and therefore this gain could be exempted due to your lifetime capital gains exemption. Now, you have $750,000 available in lifetime capital gains exemptions. So if the criteria are met, you would not pay any taxes on this gain. Now, since we are not quite sure if it is a qualified small business corporation or not, we would need to get the financial statements of Gestion Mélanie in order to provide you with the better alternative, because in this case, we can't tell which is better. And you would be able to use these proceeds to help fund some of your other endeavors this year. And you also want to take into consideration whether the company has the cash to pay you or your sister has the cash to pay you, because that is relevant as well. Now next, Dave is going to talk about the acquisition of the franchise.
Now, Mr. Fontenelle, you have been approached by Herbalife Pharmaceutical Company. They offered you the opportunity to buy the first pharmacy franchise in Canada. They want to establish downtown Montreal. Now, we have reviewed the letter of offer, and it requires a capital involvement of $250,000. Now, this will require some financial planning. You must consider the risk of this endeavor before taking it on. There are operations in Canada, and you do not know how that company is going to perform. It requires determination of your already successful employment, and it has an implication of a potential relocation. Now, once you have assessed these risks, and if you decide to go with it, we will see what is implicated. Now, as we mentioned before, you will need $250,000. There are many sources where you can get that money from. You personally own RBC Brokerage Investments. Those have a fair market value of $150,000. You also have a capital dividend account in your holding company of $37,000. The capital dividend account is an accumulated account which comes from the contributed capital from the shareholders, or the half of capital gains that is not taxed on. Those can be distributed to shareholders tax-free. You also have a cash balance in this company of $42,000. The company also has investments in American and Canadian investments with a fair market value of $250,000. Now, where you prefer to take the money from will be your choice, but with all these sources, you will have more than enough to pay for this franchise. Now, once the required funds have been obtained, Gestion Fontenelle should set up a new corporation to acquire and hold this franchise. This will limit the personal liability that you will have throughout the franchise. Now, once this is done, you will have, we'll put the $250,000 into this new corporation to purchase the franchise. You will have an adjusted cost base and paid up capital of this $250,000. The operation of this franchise will occur in this new company. Now, once this new franchise is acquired, Gestion Fontenelle will have investments, will still have the rental properties that you own, and will have a new holding corporation that will hold the franchise. Now, it would also be beneficial to split up these business ventures to separate the risks involved. This is the ideal business structure that we would recommend for you. So Gestion Fontenelle now owns this new franchise, but we would also recommend to rolling over the rental properties out into a new corporation. Now, the way to do this is to roll over the rental properties through a Section 85 rollover. Now, a Section 85 rollover requires an election from both parties. What it does is it allows a company to roll over some assets into another corporation to maximize the tax deferral. You elect the value of the assets that you transfer, and you normally do it at minimum tax values to reduce the tax implication. Now, once you do this, you will have your real estate and the land that you will have to roll over. You will transfer the real estate at the UCC of $564,000 and the land at the adjusted cost base of $53,000 in return for consideration equal to the fair market value of these assets. The fair market value of these assets equal $850,000 in total. So through the rollover, you will be able to defer a capital gain on the real estate of $75,000 and a capital gain of $23,500 on the land. Now, the summary of this transaction is this. The elected transfer value of the assets is $617,000. Therefore, your adjusted cost base and the paid up capital will be this amount of $617,000. However, this new company will be worth $850,000, which is equal to the sum of the fair market values of the land and the real estate. Now, in summary, Gestion Fontenelle will still own the original investments, but it will have rolled out the rental property into a new corporation and will also hold the franchise corporation. This effectively separates the risks involved in each business venture. Next, Thea will talk to you about the personal and family taxation issues.
Thanks, Dave. So now that Dave has addressed how to minimize your tax implications by effectively attaining that franchise and restructuring your management corporation, I'm going to talk about a whole number of personal issues that you've come to us and addressed. The first of these relates to if you do decide to acquire that franchise, there are going to be personal implications that have to do with the move that you will have to incur. So I'll touch on those. And then we're going to have to take a look at planning for the future of both your 3 lovely children and your wonderful wife. And finally, there were a couple of miscellaneous items that we'll touch on briefly too. So first of all, we're going to talk about the issues relating to the relocation. Now, Eurolife has said that they would give you a moving allowance of $20,000 if you were to relocate. And we want you to know that that allowance would be fully taxable to you. There are a number of deductions that are allowed to be taken if the move is over 40 kilometers in distance. And in this case, we've assessed that it would be. So you would have deductions against that $20,000 moving allowance. However, if you weren't going to use that whole allowance anyway, we recommend that it might be beneficial to go back to Eurolife and see whether they'd be willing to negotiate reimbursing your moving expenses, because this could occur on a tax-free basis to you. The next issue relating to your relocation has to do with the sale of your home, since you would obviously be moving. You currently own 2 properties. You have a cottage at which you summer, and you have your principal residence on the outskirts of Montreal. So if you were to sell your principal or your place where you reside most of the time, at this point in time, you would, it looks like, incur a $100 capital gain. However, there is something in Canada called the principal residence exemption. So if you were to elect to designate that house as your principal residence for a length of time, you could effectively either minimize or completely eliminate that taxable capital gain going with that sale. So the thing about the principal residence is you would have to designate the number of years that you wanted to attribute to your cottage and the number of years that you wanted to attribute to your house. And you would allocate your gain accordingly. So we would have to discuss what would be most beneficial in your case. Now we're going to take a look at planning for the future of your children and your retirement of your wife. Now, before we get into the minor details of that, we wanted to discuss an overarching vehicle that could be used to achieve the best planning for the future of all of those parties. And that's the establishment of a family trust. Now, a trust is a great vehicle, and in your case, since you already have a management company, you could issue shares of your management company to that trust for a nominal value. And if you were the trustee, you could decide who the beneficiaries of that trust were, and you could effectively allocate income to them at your discretion. So you could elect to make your wife and your 3 children the beneficiaries of that trust, and then those shares of your management corporation that were in the trust could effectively pay dividends, which you could distribute to those parties at your discretion. So this could be a great tool to help decide who needs income and when. For example, your older son who's going to university might have a lot of expenses related to that, and it looks like you hadn't set up an RESP for him in the past, so this could be a great tool to give him some income. Furthermore, it could help your wife plan for her retirement because although, as we'll discuss, she hasn't currently topped up her contributions to her RRSP, she doesn't have any earned income at the moment, so she's not really going to be accruing a lot more room in there in the future. So that's why this family trust could be a great thing. And one other thing that this will do is it will allow those beneficiaries, upon the eventual sale of those shares, to divide the sale of the shares amongst their lifetime capital gains exemptions. So that's another great attribute of this vehicle. So we absolutely recommend that you think about establishing a trust. Now we'll look at some of the other items relating to the future of your family. So as you've mentioned, you have 3 young children. The eldest is just about to embark on his journey at university. And there are other ways that we can help to minimize the tax implications of that journey and of the journey of your 2 younger children. So the first vehicle that we want to take a look at is a registered education savings plan. Now this is a great vehicle which you can contribute to help your children fund their education. You don't get any sort of deduction from contributing to it, But the government will also sort of match your contributions to the plan via a grant, and any investment income that accumulates within this RESP will eventually be taxable to your kids upon withdrawal. Now, we definitely therefore recommend that you establish this RESP for the 2 younger children. It might be a little late to do so for the 19-year-old, but as we said, the trust would solve any problems relating to income there. Now, if your 2 younger children do choose not to attend university in the future, the government contributions would have to be refunded, but you would, only the investment income that accrued within that RESP would be taxable. So another item that we would touch on relating to your son's education is the tuition and education tax credits that he would receive. So essentially he could transfer up to 5,000 of those amounts to you, and that would probably be a good course of action given that you've mentioned that you're going to be funding his education. So, and it would reduce your taxes payable. So that would be a good option to look into. Now we're going to take a look at the retirement of yourself and your lovely wife. Your wife currently has RRSP room of $42,000, and we recommend that she contributes up to that limit as soon as possible. She could obtain the funds to do so via the dividends paid through that trust. And you should also contribute and top up your own RRSP because these will provide you with deductions. And in the future, if your wife continues to have no earned income, you can contribute to her RRSP up to your own limit. So you can make a spousal contribution in that manner to help fund her retirement. We did notice in reviewing your personal finances that it appears that although you're using a tax-free savings account, which is another great tax deferral vehicle, you have over-contributed over the limit to that tax-free savings account. Now, the cumulative limit at the end of 2012 was $20,000. You appear to have contributed closer to 40. So we recommend that you remove the excess as soon as possible to avoid any future penalties. And there were a couple of miscellaneous items that we noticed in going through your statements. So first of all, you did default on a personal loan to your good friend Danielle, and that's very unfortunate. You lent her some money, $25,000, and her business did unfortunately go under, but you were never a direct stakeholder in that business. You made a personal loan to a friend, so unfortunately, we don't see any tax relief that could result from that loan. It would have been different had you invested in it, but as it is, this is just a personal loan, and unfortunately, there's no relief that we see that could be provided. And next, the CRA did come back to you and make a reassessment. And you were a little upset about this, but it does seem that this was allowable given that it was within the 3-year time period after their initial assessment. So unfortunately, you will have to go along with the fees that they recommend that you pay. However, it should be noted that you did incur some professional fees to do with that assessment and the resolving of it. So those would be deductible to you. So in conclusion, we've taken a look at how you can effectively withdraw your share of your sister's business. And we've discussed the deemed dividend and the capital gain that could occur with that. And we've determined that you do need to take a look at your sister's finances. We've taken a look at how you could best acquire that franchise to defer your tax implications. And we've discussed in the process the restructuring of your holding company, Gestion Fontenelle Incorporée. And that restructuring is an effective mechanism to defer the risks that are inherent in those 3 businesses. Because that franchise, it's an up-and-coming business, it's never taken off in Canada. So by performing that restructuring, we put the franchise and isolated its risks. We've done a Section 85 rollover to isolate any risks from your rental properties. And we've established the overarching management corporation and that trust on the side. So effectively, we've taken a look at that structure and done the best that we can to reorganize that to maximize your positive tax benefits. And finally, we've addressed a number of your personal and family tax implications. We've discussed how issues relating to your relocation can minimize their negative tax implications. We've looked at the future for your children and your lovely wife, and we've talked about those couple of miscellaneous items. So in conclusion, although I can't help you with your golf score today, and I'm not a personal trainer and I can't help you reduce that waistline, Dave, Megan, and I certainly hope that we have helped you reduce your income taxes payable, and we wish you all the best in meeting your other resolutions and a very happy new year. Thank you.
I have a quick question with regard to the source of the financing of the franchise, the acquisition of the franchise. Since I don't want to sell my various funds, is there another way that we could finance the franchise acquisition?
Well, obviously you could go with a bank loan where the interest would be deductible. That would be one key. The way we understood your situation was that you didn't necessarily want to incur more debt, but that you wanted to incur it by yourself and without having any more debt.
But would it be more efficient, tax efficient I mean, if we borrow funds instead of selling our funds?
The way it would be efficient is if your return on investments would be greater than the interest rate you're paying on your loan, but it would increase your risk in the business.
That's it. Thank you very much.
Thank you very much.
Thank you.
Good answer. Merci beaucoup.